What if a single signature could change the way your paycheck stretches, the way your investments perform, and even how much you pay at the grocery store? That's the power of a federal budget bill, especially one as big and controversial as the latest signed into law by former President Trump. You might not see the effects in your bank account tomorrow, but rest assured, this bill reaches into almost every corner of our financial lives. And here's the kicker. The changes it brings probably aren't what most Americans would have hoped for. Let's break down why this budget bill matters so much, even if you aren't glued to C-SPAN or tracking every congressional vote. At the core, a federal budget is a blueprint for what the government will spend money on, and, just as importantly, what it won't. It's not some abstract political chess move. It's a real-world document that determines funding for everything from Social Security checks to military contracts, from food assistance programs to infrastructure projects. It also spells out how much the government will borrow, which in turn influences the overall health of the economy. The bill in question is massive. Think trillions, not billions. While the headline numbers might sound impressive or intimidating, what really matters is how those dollars get divvied up and what's getting cut or expanded. Under Trump's administration, the focus of the budget was clear. Significant increases in defense spending, cuts to social safety nets, and a substantial reduction in regulatory oversight. The idea, according to supporters, was to turbocharge the economy by slashing unnecessary government programs and letting private enterprise lead the way. But here's where things get a little risky for everyday investors like you and me. The budget's priorities, particularly the deep cuts to programs like Medicaid, food assistance, and housing subsidies, don't just affect the people who use those programs. They ripple outward, touching the broader economy in ways that aren't always obvious at first glance. For instance, when millions of Americans lose access to basic support, consumer spending tends to drop. And since consumer spending drives about 70% of the US economy, that's not a small thing. Less spending can mean slower economic growth, fewer jobs, and ultimately, less money flowing into the companies you might invest in through your retirement account or brokerage app. Then there's the question of the national debt. The Trump-era budget bill didn't just shift spending priorities, it supercharged government borrowing. Despite promises to balance the books, the reality was a ballooning deficit. In 2019, the deficit climbed past $1 trillion for the first time in years, thanks in large part to tax cuts and increased spending. Now you might be thinking, why does the national debt matter to me? Here's the deal. When the government borrows more, it competes with private companies for loans, which can push interest rates higher over time. That means mortgages, car loans, and even credit card rates could tick up, costing you more in the long run. Higher government debt can also make investors nervous about the country's financial stability, which can lead to stock market volatility or even a weaker US dollar, potentially making your imported goods more expensive. Supporters of the bill argued that slashing regulations and cutting taxes would unleash a wave of business investment, create jobs, and ultimately pay for itself through stronger growth. There's some precedent for that. Reagan-era tax cuts, for example, did ignite a period of economic expansion in the 1980s, though the deficit also grew. But here's where the numbers get tricky. Most economists agree that the 2017 tax cuts, coupled with big spending increases, did provide a short-term boost. In 2018, GDP growth hit 2.9%, and unemployment dropped to historic lows. But the effects faded quickly, and the long-term impact has been more muted. The Congressional Budget Office projected that, instead of paying for itself, the tax cuts would add nearly $1.9 trillion to the deficit over a decade. And let's not forget the broader economic context. The US population is aging, and programs like Social Security and Medicare are becoming more expensive to maintain. The Trump budget didn't tackle these long-term challenges. Instead, it set the stage for even bigger deficits down the road. That's a concern for future retirees, who could see benefits trimmed or taxes raised to plug the gap. So what does all this mean for investors? For starters, it's a reminder that economic policy isn't just political theater. It has real, tangible consequences on markets and portfolios. If government spending cuts slow down economic growth, That can drag down stock prices, especially for companies that depend on consumer demand. If deficits keep growing, interest rates might rise, making it more expensive to borrow for a home, a car, or even to refinance student loans. And if the government eventually has to raise taxes to pay for all this borrowing, that could eat into corporate profits, and by extension, your investment returns. It's easy to get caught up in the day-to-day noise of the markets, but smart investors pay attention to the long game. That means looking beyond the headlines and understanding how policy choices, like a massive federal budget bill, can shape the financial landscape for years to come. Sure, you might not feel the impact today, but over time, these decisions can add up, influencing everything from your job prospects to your retirement nest egg. In the end, the lesson is clear. Economic policy is never just an abstract debate in Washington. It's the backdrop to every financial choice we make, whether we realize it or not. So the next time you hear about a big budget bill being signed into law, don't tune out, tune in. The future of your wallet might just depend on it.